It's the week the market's been waiting for 2 years, but rate cuts could finally be here. Here to talk about what this means for the market volatility is MarketBeat analyst Thomas Hughes. Thomas, you've been following all of the economic factors very closely for the last few years. And this week, this month especially, we've seen a lot of volatility. What's behind that?
Well, the volatility started back in July with the CPI report. It was kind of exacerbated over the last few weeks with the PCE and the CPI report again. But what it means is the market is getting ready for a shift in economic fundamentals. As you said, we've been waiting for years for the FOMC to lower interest rates. When they lower rates, it will ease economic headwinds. It's supposed to help not accelerate growth, but help invigorate the market so that it can sustain the growth that it's at without too much inflation. The takeaway from that is the market's looking for a sector rotation, getting out of all the highly concentrated names that have been invested in over the last 2 years in preparation for the next stage of rallying.
You mentioned CPI. Let's talk about what last week's CPI report release kind of did to the market all of last week.
Well, last week's CPI report, I would call a Goldilocks number. It wasn't too hot, it wasn't too cold. Um, I believe the headline number was a tenth cooler than expected, but that really wasn't too much. The takeaway is that inflation isn't cooling so fast that we're in fear of recession, and it's not so hot that the FOMC won't cut rates. It's right in line with the idea of a soft economic landing. The takeaway is that the market won't get aggressive rate cuts, but we should get the first rate cut this week and at least one or two more by the end of the year.
Right after that CPI report was released on Wednesday morning, we saw a sharp market downturn, but then it finished up stronger at the end of the day, and we saw a little bit more of that throughout the week. What should investors take from that kind of action?
Well, the takeaway is that volatility is here. The initial reaction was very bearish, and in the article I wrote, I even took a bearish tone. It looked very bearish. The late day surge on Thursday was pretty surprising, but it plays right into the idea of volatility. The next day, the day after, the market didn't follow through on that move. So ultimately, what we're looking at is a high volatility period, but not so much of a downtrend or a market correction, but in a sideways moving market. So we should expect to see day-to-day action move kind of sideways. Each up day will be followed by a down day, and that'll probably persist through September and maybe past the election.
Do you expect that volatility to continue even after we get Wednesday's report or potential interest rate cut?
It may actually increase after the rate cut because the rate cut should come with a policy statement that either affirms or refutes the market's outlook. The way I see it right now, the economic data is still solid enough that the Fed shouldn't cut rates too quickly, because by cutting them too quickly, they could actually reaccelerate inflation. They don't want to do that. So again, high expectation for a cut this Wednesday, also a high expectation for the policy statement and what it may point to later on in the year.
So, the soft landing that they're looking for, what would that actually look like, Thomas?
Well, what that looks like is inflation slowly trending down to the 2% target rate, the FOMC able to slowly cut interest rates to the point where inflation stabilizes at or near that 2% rate. Because the economic data is still so good, I mean, to me, it's very healthy relative to pre-pandemic periods. That should lead to a broadening economic rally, because with weakened or diminished economic headwinds, a wider range of businesses, those more susceptible to interest rates, will be able to have better business. Consumers should start spending more. And so we should really see a really much broader stock market rally, possibly beginning early to mid next year.
That all sounds like the ideal soft landing, but I think there's a lot of questions on will it actually go down that way? Is that why we're seeing so much volatility right now?
Right, that is the volatility. I mean, that's that's the in a nutshell right there, because we're on this tightrope path towards 2% inflation. We have the soft landing in play, but there are risks. The FOMC, maybe they held rates high for too long. That could cause a recession. If recession's in the cards, we won't even know it until the next round of monthly data comes out. But at the same time, if the Fed hasn't done their job enough, inflation will only reaccelerate, and that will keep us in a higher for longer state. So again, the market is just wrestling with this what if scenario of what's really happening while the soft landing is taking place.
So expect a lot of ups and downs along the way while we try and figure out where we're at.
Right.
Thank
If we
you.
haven't said it enough in this video, volatility is the name of the game for at least the next month.
All right. Well, thank you very much for the analysis, Thomas, and for going through where we're at right now. It's going to be a big week ahead, and we will follow it all right here at MarketBeat. Thanks for following us. Make sure to like and subscribe to our channel for more market news. And as always, happy investing.